Welcome, friends, to our Ind AS Knowledge Series video number 11. Today, we will be discussing Ind AS 21, the effects of changes in foreign exchange rates. We have an equivalent standards in India, AS 11, and there are significant differences between AS 11 and Ind AS 21 as far as the accounting for the effect of changes in foreign exchange rates. Mainly because in an Indian accounting standard perspective, that's the Ind AS perspective, we will be dealing with multi subsidiaries, multinational investments in associates and joint ventures, and transactions with many other countries, whether it is simple to accept only the question of the exchange currency at which the transactions are entered into or the investments are made, and subsequently restating that number into the presentation currency. So Ind AS 21 felt that it is an equivalent standard in IFRS is IAS 21 with the same number, felt that there needs to be some more additional discussion we should consider when we are talking about accounting for the changes in forex rates in the standalone as well as consolidated financial statement. And to that extent, a detailed guidance is available under Ind AS 21. The standard is a very small standard, but still we will be discussing with a lot of case studies for the purposes of our understanding, because the complexity involved in accounting for forex differences are quite significant. Friends, before I go into the standard proper, I must thank all of you for giving very good feedback, encouraging comments, and also request to consider certain additional areas in each of the standards, posting a lot of queries which has to be answered. I am overwhelmed with your response, and I am also feeling that whatever I am doing to kill my time is actually helping in benefiting a lot of professionals as well as students when they are preparing for their CA final examination. I'm very happy. And what I suggest is you can share this video as well as the other videos, or maybe you can ask your friends to subscribe to the channel so that whenever I upload a new video, they will automatically have the link for that, and they will also get benefited. In simple terms, let the knowledge be reach the largest audience level rather than only within ourselves. And another thing which has been appreciated by many of the students uh, who are preparing for CA final examination is the entire presentation is in English, and we are not switching over to any other vernacular language, even for the purposes of small references. And accordingly, a lot of people who does not know or not able to understand the other presentation which are available in YouTube channels where it is being conducted in the local language are capable of being understand this entire Ind AS standards. So I'm very happy to note that particular aspect as well. So please share this video and also ask your friends to view this video so that the knowledge can go for a larger audience. With this, let us go to the standard prop. Welcome, friends, to our Ind AS Knowledge Series video number 11. Today, we will be discussing Ind AS 21, the effects of changes in foreign exchange rates. We have an equivalent standards in India, AS 11, And there are significant differences between AS 11 and Ind AS 21 as far as the accounting for the effect of changes in foreign exchange rates, mainly because in an Indian accounting standard perspective, that's the Ind AS perspective, we will be dealing with multi subsidiaries, multinational investments in associates and joint ventures, and transactions with many other countries, whether it is simple to accept only the question of the exchange currency at which the transactions are entered into or the investments are made, and subsequently restating that number into the presentation currency. So Ind AS 21 felt that it is an equivalent standard in IFRS is IAS 21 with the same number, felt that there needs to be some more additional discussion we should consider when we are talking about accounting for the changes in forex rates in the standalone as well as consolidated financial statement. And to that extent, a detailed guidance is available under Ind AS 21. The standard is a very small standard, but still, we will be discussing with a lot of case studies for the purposes of our understanding, because the complexity involved in accounting for forex differences are quite significant. Friends, before I go into the standard proper, I must thank all of you for giving very good feedback, encouraging comments, and also request to consider certain additional areas in each of the standards, posting a lot of queries which has to be answered. I am overwhelmed with your response, and I am also feeling that whatever I am doing to kill my time is actually helping in benefiting a lot of professionals as well as students when they are preparing for their CA final examination. I'm very happy. And what I suggest is you can share this video as well as the other videos, or maybe you can ask your friends to subscribe to the channel so that whenever I upload a new video, they will automatically have the link for that and they will also get benefited. In simple terms, let the knowledge be reach the largest audience level rather than only within ourselves. And another thing which has been appreciated by many of the students uh, who are preparing for CA final examination is the entire presentation is in English, and we are not switching over to any other vernacular language, even for the purposes of small references. And accordingly, a lot of people who does not know are not able to understand the other presentation which are available in the YouTube channels where it is being conducted in the local language, are capable of being understand this entire Ind AS standards. So I'm very happy to note that particular aspect as well. So please share this video and also ask your friends to view this video so that the knowledge can go for a larger audience. With this, let us go to the standard proper. As usual, we have structured the standard to understand the objective of this standard. A new concept is coming in this standard: functional currency. Unless we do not understand what is functional currency, accounting for the changes in foreign exchange rates under Ind AS 21 will not be possible, or we may get a wrong answer when we are doing this. So we will spend a lot of time in understanding what is the meaning of functional currency, what are all the indicators of functional currency, how the functional currency has to be set or determined. In simple terms, the standard says that first you have to determine what is the functional currency and then only you have to proceed. The gated step is to determine the functional currency of the entity and then proceed further in accordance with this standard. And to that extent, understanding the functional currency is very, very crucial for this standard. We will discuss that for our understanding on a go forward basis. And we will have a lot of case studies to understand this particular concept. As we have seen, this is also an accounting standard. It's not mere disclosure standard. And accordingly, when the particular transaction occurs in a foreign currency or particular investment has been made in a foreign operation or particular transaction has happened or we are translating the uh, financial statement of which is denominated in another foreign currency into the presentation currency which is different, how the initial recognition of assets, liabilities, income, expenses has to be done when the transaction occurs is what we have to see here also. And subsequent measurement, that is how the foreign currency transactions has to be translated into the functional currency or the uh, presentation currency. In case if the functional currency and presentation currency are different, what is the accounting treatment which we have to do? That's similarly how the foreign operations or investment in foreign operation has to be translated uh, when accounting under this particular standard. Similarly, I have a financial statement which was denominated in another foreign currency and I have to put it in the presentation currency of the entity for the local jurisdiction or local regulators. For example, if I have a subsidiary in US which presents the financial statement in US dollar, but for the purposes of consolidation in India, I have to convert that financial statement into INR. How the translation has to happen with respect to the financial statement which has been presented in US dollar is another area of concern according to this standard. In simple terms, actually, if you are going into the standard, the bullets 4, 5, and 6 is what we are going to do. If there are some transaction which has happened in foreign currency, how it has to be translated to the presentation currency. If I have made an investment in a foreign operation, how it has to be translated in the standalone and consolidated financial statement and in accordance with the presentation currency. If I'm converting a financial statement which has been presented in another foreign currency into the presentation currency of the entity's own country, how that will be done. This is actually what we are going to do as an accounting principle. And for that, we are trying to understand what is a functional currency. And this I have seen that when we are comparing this standard with our existing knowledge of accounting standard AS 21, we will be able to understand quickly what is the complexities involved in Ind AS. And to that extent, if we concentrate only to those areas, it is enough for the students and the professionals to be an expert on Ind AS 21. So we will discuss the significant differences between Ind AS 21 and AS 21. I also always believe that the taxation impact of any accounting principle is one of the major concern of the entity as well as the tax practitioners when they are advising the clients. And to that extent, we should also understand what is the significant differences between this Ind AS 21 and the ICDS relating to forex differences, because there is a specific ICDS 6 which is talking about the forex differences. We will try to understand the differences on the taxation perspective. And finally, since we have done the accounting, since we have measured, subsequently remeasured the numbers, we will only have to understand what are the major disclosures required as per this particular standard. So, what we are going to do with respect to all these critical elements of this particular standard, we will have lot of exercises, lot of examples and lot of case studies so that the concept can be understood without even an iota of doubt. In case, even after this presentation, you have some more doubts to be clarified, you are most welcome to send that to my email ID, or you can free to call me, and it will be my pleasure to address those questions, because I always believe that if an interaction is available, my knowledge will also get improved because of the specific questions which you are asking for. With this, let us move on to the objective of this particular standard. As I have said, if an entity has a transaction in foreign currency, or entity has investment in foreign operations, or the entity wants to present a financial statement which was denominated in a foreign currency into a different currency, how to do that? The guidance is available as per Ind AS 21. And it says that how the foreign currency transactions and foreign operations can be included in the standalone financial statement and consolidated financial statement of the entity, as well as how you can translate the financial statement which has been prepared under foreign currency into the presentation currency in which the entity wanted to present the financial statement. So it's a simple process, only three categories: foreign entity having transaction in foreign currency, entity made investment in a foreign operation, entity wants to convert the financial statement presented in a foreign currency to the local currency. These are all the only three things which we are going to understand, and how the translation will be accounted for. Once I'm doing a translation, how the translation has to be accounted in the financial statement is also the guidance provided as per this particular standard. Let's move on to understand what are all the items which is not included in this particular standard. For example, it says derivative transactions which are denominated in a foreign currency, and whatever balances which are there at the year end are not accounted as per Ind AS 21, but it should be accounted as per Ind AS 109. So the accounting will go to Ind AS 109. Similarly, if an entity is doing a hedging of a foreign currency item, for example, it has an exports, there is a receivable, and to ensure that the entity is not losing because of the changes in foreign currency, it goes for a forward contract covering the entire exposure and uses the hedge accounting provided as per Ind AS 109. Then again, that will not be get covered under this standard. It will go straight to Ind AS 109. Similarly, an entity, when it has made an investment in a foreign operation, the net investment, that is the total assets minus liabilities, what is the exposure which is having on the investment, it wanted to uh, take some sort of hedging with respect to the possible losses which it may incur with respect to the changes in the foreign currency with respect to the investments in foreign operation. Again, that is covered by Ind AS 109. The process of doing it only when there is no hedging activity will be as per Ind AS 21 for the foreign currency items as well as the foreign operations. But the restatement, whatever number which we are doing, will be done according to these principles given in the standard, but the accounting will be done as per Ind AS 109. So you have to be very careful what items which has to be excluded. Similarly, when we are talking about presentation of cash flow statement, which arises because of the foreign currency transaction. If you remember that, we have said what is the movement with respect to the foreign currency will be shown as a reconciling item in the statement of cash flows, which we have said when we were discussing Ind AS 7. So that items are covered in both the fourth and fifth bullet. And the sixth one is important for us to understand, because we will discuss this as an exception in a lot of scenarios. First point is we have to understand what is there in AS 11. You may recollect paragraph 46 and 46A of Ind AS, AS 11 says, at the option of the entity, if there is a foreign currency gain or losses with respect to long-term foreign currency monetary items, it says it can be carried forward and amortized over the repayment period of that long-term foreign currency monetary liability, assuming that that foreign currency liability has been taken for other than depreciable asset. So it will be normally accommodated as per AS7, foreign currency monetary items translation account, FCMI DDA is what shortly we call, and we will show as part of the reserves and surplus, and it is amortized over the repayment period of the loan. Instead of charging the entire differences in the particular year, it will get accumulated in the reserves, and there is an option which has been provided. If the option has been taken up to 2021 as per paragraph 46A of AS 11, up to 2021 the carry forward and adjustment will happen, or earlier of the period where the loan has been settled. This is a provision given in 46A. 46 is redundant because 46A takes over the position, and it allows even the new contract to be taken up to 2021 if the entity opts for it. Suppose if the foreign currency liability has been acquired for the purpose of acquiring a depreciable asset, then it says that don't accumulate in FCMI DDA, but take it as part of the depreciable amount or the cost of the asset and depreciate over the useful life of the asset. So, for example, I have taken a foreign currency loan to acquire a property, plant, and equipment, and the foreign currency loan has to be settled over a period of 5 years. During that 5 years, whatever losses or gains which I am having in restating the foreign currency liability to the year-end day rate of the currency or reporting currency, that differences will go to the added or deducted. Added means if there is an exchange loss, it will be added to the carrying amount of the PPE. If it is a gain, it will be reduced from the carrying amount, and the depreciation will be on the revised number over the useful life of the asset. So one, on the basis of whether it's a depreciable asset, it is added or deducted to the carrying amount and depreciated over the useful life of the asset. Suppose if I am saying it is not relating to a depreciable asset for other long-term item, then that will be carried in FCMI DDA and amortized over the repayment period of that foreign currency or long-term monetary liability. Okay, this is what given in uh, as an exemption or option in paragraph 46A of AS 11. If an entity has opted for it, it is an irrevocable option. That means it has to restate all the long-term foreign currency monetary items, both assets and liabilities, and take that only to reserve. It cannot charge it to P&L account subsequent to the adoption of the option. It is an irrevocable option as per AS 11. What has happened to that particular exemption under Ind AS 21? When Ind AS 21 has been prepared in accordance with IAS 21, the provisions given in IAS 21 as well as Ind AS 21 says that all the foreign currency differences, unless if it is exempted or it is to be accounted in OCI or the equity, we will have that situation. Those items has to be charged to the profit and loss account. Other than the exempted items, all items should be charged to the profit and loss account. There is no option of carry over in the carrying amount of the asset or carrying over in FCMI DDA, which is not given in Ind AS 21. But at the same time, what MCA has felt is that a lot of companies have opted for this exemption when they have applied or prepared the financial statement in accordance with AS AS, that is accounting standard, and they are transitioning to Ind AS, all of a sudden the entire FCMI DDA, if I'm withdrawing this, has to be adjusted in the opening retained earnings or maybe into the P&L account, which will not be correct, or it will have a complete hardship to the entity. So to that extent, what it has been suggested is to give an option as per Ind AS 101. Option or exemption has been given for the first time adopter if there are any arrangement or contract entered into with respect to long-term foreign currency monetary items. Exemption has been given as per para D13AA of Appendix D. Appendix D is talking about the exemptions given as for the first time adopter. So that paragraph allows the existing arrangements or contracts where the entity has already opted for this exemption of uh, taking it to the depreciable asset or taking it over in FCMI DDA and amortizing over the loan repayment period will be permitted to be continued with the same accounting treatment up to the commencement of the reporting period. That means, for example, if I am talking about a company which is going for the first time for Ind AS reporting for 31/3/2020, whatever foreign currency long-term contracts or arrangement which has been entered into and for which the option given in paragraph 46A of AS 11 has been applied up to 1/4/2019 is continued to be allowed in the same basis as per AS 11. All other contracts entered into subsequent to the opening date has to be charged or has to be accounted as per Ind AS 21, and this exemption is not available as per Ind AS 21. So only for first time adopter there is an exemption. So if any such exemption has been already availed and they have took the option, and for that particular item Ind AS 21 will not apply. I will compute the restatement according to the principles of measurement, but recognition will be done according to the exemption which is given in Ind AS 101. This we have to be very clear because this exemption is dealt with in some other slides as well. At that point of time, I will not explain in detail. So we should know about the paragraph 46A of AS 11 is permitted to be continued as per an exemption given for the first time adopter if the contracts or arrangements have been entered before the date of reporting. So that is the thing which we have to consider. Okay. So with that, we will go into the key concepts which has been referred to in this particular standard. It talks about the types of currency which we have to understand first. If there is a difference between one currency to another currency, it requires a accounting for the differences, and how to deal with the impact of the differences is also given as the guidance. Similarly, for example, if we are going to talk about foreign currency, suppose if the transaction which has been entered into in a foreign currency, but my accounting or the reporting currency or the presentation currency is a different currency, then how the foreign currency transactions will be converted or translated or remeasured as per the presentation currency is what we will see. So if foreign currency is nothing but currency other than the functional currency of the entity. So we are not using the word recorded currency. So it is simply saying that it's a functional currency. Functional currency is equivalent to the transaction currency as per AS 11. In simple terms, sorry, not transaction currency, the recording currency, the currency in which it has to be recorded in the books of accounts is what as per AS 11 is equivalent to functional currency. We will see in detail what is the guidance which has been given for functional currency. So we should know what is the second currency, which is the functional currency. Functional currency is nothing but the currency of the primary economic environment in which the entity operates. That's the reason why I said, suppose if I have a transaction in US dollar with respect to my exports, but I'm an Indian company, the primary economic environment in which I am operating is in India, and to that extent, my functional currency will be INR, but my foreign currency, that the transaction in which I have entered into the particular export is in a foreign currency, which is not INR, it is US dollar. So there is a difference between functional currency and foreign currency that has to be remeasured for the purposes of accounting in the financial statement, both standalone as well as consolidated. We will see how it has to be done. And the third currency is presentation currency. You may ask, sir, normally the financial statement in India is presented in INR. Why should we worry about if in case if I am talking about a company which is having a functional currency of INR because it is operating in the primary economic environment in India, and accordingly we have determined that INR is the functional currency, and we are also going to prepare the financial statement as per in INR. So why should we worry about the presentation currency? Please understand there could be a possibility of the entity preparing the financial statement for some specific reasons. For example, it is going to list its shares in a foreign stock exchange. It may be required to convert that in US dollar or maybe UK pounds or Singapore dollar, as the case may be. In that particular scenario, the functional currency is INR, but the presentation currency is a different currency. How this has to be done? When we are saying if there is a difference between functional currency and foreign currency, we said it is remeasurement. Please understand two concepts. We are remeasuring the transaction in accordance with the functional currency because the transaction is entered into foreign currency. What is the impact of the remeasurement goes into the P&L or the other cases, we will see the accounting principle. When the functional currency is different from the presentation currency, we call that as a translation. Remeasurement is different and translation is different. Remeasurement is the assets and liabilities, income and expenses, or the transaction itself is remeasured, and the impact is accounted in a different style or different principles. Whereas if the functional currency and presentation currency are different, they are translated, and the translation difference is accounted based on the guidance given, which is little different from remeasurement differences being accounted as per Ind AS 21. So what is presentation currency? The currency in which the financial statements are presented. So what is the US dollar? I am denominating the balance sheet, profit and loss account, cash flow statement, statement of changes in equity, notes and accounts, everything as per US dollar, even though my functional currency or the major economic environment in which I am operating shows that my functional currency is INR. Even in that case, since my presentation currency or the financial statements are prepared and made as per USD, there is a translation which we have to consider. So what we have seen here, there are three types of currency. One is the foreign currency, which is other than the functional currency of the entity. Second, what we have seen is the functional currency, normally determined by the major economic environment in which the country, in which the entity operates, decides the functional currency. Third, we have seen presentation currency. That presentation currency is nothing but the currency in which the financial statements are presented by the entity. Between the foreign currency and functional currency, if there are some differences, then that impact we call it as a remeasurement. And when we are talking about the difference between functional currency and presentation currency, we call that as a translation. So we are clear up to this particular point of time. Now we have to understand this concepts little further with some examples, because we have given the basic principle, right? What is foreign currency? What is functional currency? What is presentation currency? Let us take one example for us to understand. even though we are talking about Ind AS, but I'm taking an example of a foreign company for you to understand the various transactions. The Canadian company, majority of its operations are in US, and it presents the financial statement and P&L in Canadian dollars because it's a Canadian company, it's Canadian dollars. But the bulk of its operations are in the United States. The majority of the transactions will be in US dollar. During the month, major sales is in UK amounting to 1 million pounds. What is the foreign currency? What is the functional currency? And what is the presentation currency? Let us go back to our previous slide. The previous slide says transactions are happened in other than functional currency. That means we have to first understand what is a functional currency. Let us understand that. The functional currency in this case is nothing but US dollar because bulk of its operations or the major economic environment in which the entity is operating is in US. Even though the company is a Canadian company, major economic environment in which it operates is in the US. So to that extent, functional currency becomes US dollar. Now, what is the foreign currency? Naturally, UK is UK pounds or sterling pounds is definitely a foreign currency because it's other than the functional currency. Presentation currency, we have said, given in this example itself, it prepares and presents the financial statement in Canadian dollars. So that becomes the uh, presentation currency. If between the functional currency and the foreign currency, for example, $1 million, 1 million pounds of transaction has happened in the month of March 2019. So it has happened in a foreign currency. So 1 million pounds on the date of transaction has to be converted into what is the equivalent US dollar and accounted in the books of accounts. Any difference which is arising between the in the conversion or in the remeasurement of that particular transaction will be accounted as per Ind AS 21. Uh, Without holding further, I will say that normally it goes into the P&L account. When there is a difference between foreign currency and functional currency, you remeasure the transaction, it goes to the P&L account. Suppose in this case, the presentation currency is going to be a Canadian dollar rather than the functional currency. So there is a difference between these two. And to that extent, when the closing financial statements which are recorded, the transactions, assets, and liabilities are recorded as per US dollar, will be converted into Canadian dollars for the purpose of financial statement. So that is resulting in a translation. When the translation is happening, it is normally not charged to the profit and loss account. It is taken to equity or OCI as the case may be. We will see that particular item. When we are translating this, what will happen? We call it as a foreign currency translation reserve adjustment that normally goes into OCI and then it goes to the balance sheet as part of the statement of changes in equity. That's a simple principle. If I am remeasuring a transaction which has happened in a foreign currency, but my functional currency is different, I remeasure it and charge it to the P&L account. If I have a functional currency, but the presentation currency is going to be different, I translate the items, the difference arising out of that translation is dealt with in the equity. So this is a simple principle, but the confusion is what is functional currency will be the biggest confusion. Let us take some of the example for us to understand. In this case, an Indian parent holds investment properties and equity and debt finance in rupee. So it has investment properties, it has equity, it has taken loans in rupee, that is INR. So why I'm keeping that the debt finance and investment properties, etc. There are some primary indicators and secondary indicators which we will discuss a little later for our understanding. That's the reason why I'm putting this. You keep this illustration on your mind when I'm discussing the or we are debriefing the case study. You will have a lot of idea behind how the principles of functional currency will work when we are talking about primary indicators and secondary indicators or mixed indicators as the case may be. It also has one Russian subsidiary where it owns investment property. And the entire investment property held in Russia is financed by the holding company, and the income arising out of that is remitted back to the holding company. The Russian subsidiary does not have any active management. It simply has an investment in uh, the investment property, collects the income, adjusts the local expenses, and send it back to the parent company. In this scenario, what is the functional currency? What is the presentation currency? And what is the in case if we have to consider as foreign currency? So let us first understand what is a functional currency. If we are seeing, even though the Russian subsidiary is operating in Russia, we will normally try to understand that major economic environment in which it operates. But when it comes to parent and subsidiary company, one of the indicator which we have to see is that whether the subsidiary is having a substantial degree of autonomy. That is, it generates its own cash flows without depending on the parent, and it retains that for its operations in the local currency, that is in Russian currency. If it is maintaining that, then it is said to have a substantial degree of autonomy. In that case, the major economic environment which it will operate will be considered as Russia, and to that extent, Russian currency will be considered as the functional currency. But in this facts of the case, we are seeing that the Russian subsidiary does not have an active management. It simply takes the amount from the parent company, and to that extent, it is only operating as a pass-through entity. And to that extent, INR will be the functional currency even for the Russian subsidiary. But the Russian subsidiary, for its standalone purposes, prepares a financial statement in Russian currency. To that extent, there is a difference between the functional currency and the presentation currency, and there will be a translation which will be taken to equity by in the standalone financial statement of the Russian entity. As far as the parent company is concerned, INR is the functional currency, presentation currency is also in INR, and only when they are making an investment in the subsidiary, there comes our second situation, which is covered in Ind AS 21, which says that this is not a transaction in foreign currency, but it is a transaction on investment in a foreign operation. So to that extent, how the investment in foreign operation has to be accounted in the parent company, or the standalone financial statement of the parent company comes into picture. That we will see the accounting principle little later. But for our understanding, in this case, the functional currency for the subsidiary also, it's only INR. Suppose we are talking about some intermediate holding company. What do you mean by intermediate holding company? Let us see the fact pattern. There's a holding company which has US dollar. In this example, I am talking about US dollar. Suppose if you are saying holding company is in INR, that is also possible. We can take that also, and again you will reach the same conclusion. Holding company is having the functional currency of US dollar, and it has one intermediate holding company. What is mean by intermediate holding company? Assuming that company A is the ultimate parent company, it has invested in company B, and company B in turn has invested in two subsidiaries, step down subsidiaries. So in that case, ultimate parent company or the holding company is company A. B is considered as an intermediate holding company within the group, right? So intermediate holding company, it has made an investment, and it has also made an investment in a subsidiary too. And for that subsidiary too, also the functional currency is US dollar. It also has a subsidiary 3 where that is also having US dollar. Subsidiary 4 is having functional currency of Singapore dollar, and the intermediate holding company is having two step down subsidiary. One has in China, and it has Chinese currency as the functional currency, and it has a Hong Kong investment, and that has the functional currency of Hong Kong dollars. In that situation, what is the functional currency of the intermediate holding company? You may also ask another question, sir, how the conversion will happen, remeasurement will happen, whether it will be done between the step down subsidiary and subsidiary to directly with the holding company, or first we will do the consolidation and accounting as per uh, first step. Step down subsidiary 1 and step down subsidiary 2 will be consolidated with the intermediate holding company, and then with all other subsidiaries it will be consolidated with the holding company. Both the options are available under Ind AS 21, that is step by step conversion or direct conversion. Both options are available, and depending upon what is beneficial to the entity can decide to have that. Okay, that we will see it in a little later slide. Now, the question is, what is the functional currency for the intermediate holding company? Now, one additional fact is coming in this question. Because if the intermediate holding company is having complete autonomy and it generates its individual cash flows and retains the assets in its own currency, assuming that it's operating in Singapore and Singapore dollars, then the answer will be totally different. It will become having a substantial degree of autonomy, and to that extent it will have Singapore dollar as a functional currency because it's a major economic environment in which it operates is Singapore dollar. But in this case, the fact says the intermediate subsidiary has been incorporated only for tax benefit, because if you are setting up the step down subsidiary which makes huge profits, the taxability, assuming that in India, is much higher. But if you are having in tax havens or countries in which the taxation structure is little low, the profits will be held at the intermediate holding company level at a lower tax level. Normally, this type of structuring for tax is a very common practice. That's the reason why even the Companies Act says not more than two layers of the parent company will be allowed, or investment companies will be allowed in the group to avoid misuse of that particular situation. So if this intermediate subsidiary has been incorporated for the purposes of tax benefit, then it is only a pass-through transaction, pass-through entity. If it is a pass-through entity, it doesn't have any substantial autonomy, and to that extent, it is considered as an extended arm of the holding company, and it will be considered as if it is the parent company itself. And accordingly, whatever is the functional currency of the parent company will be applied to the intermediate holding company, which is established only as a pass-through entities for tax benefit. If it is an independent operation, then we will consider what is the economic environment in which intermediate holding company is operating, and to that extent the functional currency could be different. It will not be based on the holding company's functional currency. Having seen this intermediate holding company, let us see, because we are talking about functional currency again and again, and what the functional currency also we have said, the currency of the major economic environment in which the entity operates is the functional currency. That is also we have seen. And what is the indicators? Actually, the starting point to determine a functional currency says you have to look for primary indicators. That means there are some conditions which you have to see primarily at the first starting point. If you get a clarity that based on that indicators, this is the functional currency, then you consider that as the functional currency. Sometimes the primary indicators are not giving a clarity. So we need some more additional guidance. So the standard gives a supporting evidence called secondary indicators that will determine, suppose if I have a confusion whether US dollar should be considered as the functional currency or the Singapore dollar has to be considered as a functional currency for a Singapore entity, because the primary indicators are seems to be mixed, then I will see as the secondary indicator whether any clarity is available, supporting evidence is available to say Singapore dollar is to be concluded as the functional currency. Suppose if this is also not there, primary indicators and secondary indicators are also mixed, and the standard says use the judgment by the entity. So normally entity will assess and decide on what basis a functional currency has been determined. Of course, the standard requires a specific disclosure of what is the functional currency of the entity and how it has been determined based on what is the indicators, primary indicators or secondary indicators. When the judgment has been used, more disclosures are required to be added as part of the notes on accounts. Now, if it is a foreign operation, we have to see, that's what we have seen, intermediate parent company, and we have talked about a company which was pass through transaction, etc. We are normally consider the indicators, whatever is applicable, primary indicators or secondary indicators which are applicable to the parent company will be considered as the indicators for the subsidiary company as well. Sometimes whatever conditions or indicators which are with the linkage of the transaction with the parent company should also be considered. Like what I have taken as one example for us to understand is the substantial degree of autonomy. We have took as one of the possible indicators or linkage between the parent company and the subsidiary company. That should also be considered when determining the functional currency of the foreign operation. Now, interestingly, can I change the functional currency every year, every reporting period? If I change, what happens to the accounting principle as per Ind AS 8? Is it a change in accounting policy or it is a change in accounting estimate? Okay. So if you see the entire discussion which we are saying, functional currency is not a choice which has been made by the entity. The entity has to see the facts, circumstances, and events and transactions based on which it has to decide, maybe primary indicators or secondary indicators, or the judgment provides that based on the present underlying events and transaction, this is what your functional currency. So it is based on the facts and circumstances at each reporting period or for the particular year, the functional currency is determined. If the facts or underlying events and transactions are changing in the subsequent year, automatically functional currency will also change, not by choice of the management, but based on underlying events and transactions. When the underlying events and transactions are changing, it is not a change in accounting policy. What is then it has to be considered? It has to be considered as a change in accounting estimate. What is the meaning of it? It has to be accounted on a prospective basis. When I am accounting on a prospective basis, the previous comparative numbers are not to be restated. It should be kept as it is because that was the underlying circumstances and transactions at which the functional currency of the last year is different and current year is different. So the balances will not be restated. Only in the current year, I will apply the new functional currency and make the adjustment. But having said that, because the functional currency changes and there is a change in accounting estimate, you have to discuss about this as part of the notes on accounts. So we are clear on what is the functional currency, how it has to be determined. Now we have to look into what is the primary indicators, secondary indicators. Let's go into the primary indicators. When we are talking about the primary indicators, why the primary indicators or secondary indicators has to be seen? Because the first step of Ind AS 21, as we have discussed earlier, is to determine what is the functional currency, start point or gated entry gated question for the applicability of Ind AS 21 is, have you determined the functional currency? Is it different from your transaction currency? If it is different from your, is it different from your presentation currency? Then only Ind AS 21 has an impact. If there is no foreign currency, if there is no different presentation currency, I do not have anything to do with Ind AS 21. I will simply go away from this standard. I am not supposed to account for it. Accordingly, the first step is to determine the functional currency, and the primary indicators to decide what is the functional currency is that first primary case is how the sales prices for the goods and services are denominated and settled. For example, all my local sales or my export sales are denominated in or received, and I'm getting it, how it is being received. I will be receiving equivalent to INR, then my functional currency as per the primary indicator is actually INR. Even though I get a US dollar, but the settlement is what is the equivalent INR is what is being done. So in that case, the sales prices, how it is being denominated and settled is normally primary indicator. But in certain cases, globally, the transactions or sale prices are denominated and settled in a particular currency. For example, a transaction for an oil and gas industry is always denominated by US dollar. A company which is or entity which is dealing with gold as a purchase or sales or whatever import export of gold, etc., that is also globally denominated in US dollar. So you have to see how the sales prices are denominated and settled, based on which you have to determine what is the primary indicators. If a company is operating in India, normally the transaction selling prices are denominated and settled in INR, and to that extent, it will be my functional currency will be INR. If I have an export or import, that is, for example, the invoice is in US dollar, that is considered as a foreign currency. Foreign currency is other than the functional currency. So between these two, if there is a measurement, I do that and take it to my P&L. Now you will be able to understand how the process starts with determining the functional currency. Second indicator, suppose if you are not very clear whether the sales prices are denominated and settled is not the basis in which you wanted to do it, it says that what is the currency of the country whose competition and regulations determine the selling prices for goods and services. For example, if I'm talking about the regulations, that's what I have given an example of oil prices, crude oil prices, or gold prices. The competitive factors or the regulations are mainly determining the selling prices. What is the currency of that particular country? So US dollar is the currency of that country. For example, we have entered into a transaction or agreement with certain Middle East countries where the settlement will also happen in INR. That's a competition or the regulations have been determined in INR. So INR in that particular scenario is also becoming my primary indicator of functional currency. This is second, based on the competition or the regulation where the selling prices for the goods and services are determined. One is I am on my own is determining and settling it. The second is based on the competitive forces and the regulation of the country, which determines the selling prices. And the third is, these two are talking about my revenues or selling prices, whereas the other one is talking about what is the cost of my goods and services which is being sold, how the cost or what is the currency which influences the cost, maybe a labor cost, maybe material cost, maybe other cost. I have to see how the labor cost or material cost or other costs are uh, settled or which currency influences. For example, if I am operating in India, why? we are considering INR as the basis, assuming that I am having only imports, not exports. The competitive forces or the regulation which may be determining the selling prices may be US dollar for that particular scenario. But what happens is my settlement is happening in INR. For me, it is not sales. So I have to go with the second one where it gives me a feeling that it could be the currency of that particular country from where I purchase. But at the same time, the third indicator says based on your cost, how the currency which influences the cost settlement. So if I'm settling that in INR, but it will be converted into the equivalent US dollar. So to that extent, my expenses, local expenses are incurred in INR, local purchases are happening in INR, other costs are incurred in INR, only a portion of the imports are settled in US dollar. So that also the majority or may in the currency which may influences the majority of my cost of goods and for providing the goods and services is the third primary indicator, either based on the selling price or based on the regulation or based on the cost incurred. We have to consider the primary indicator. So the moment I have decided the functional currency, all the assets, liabilities, equity, income, expenses, that's the 5 elements in the financial statements, right? So all of them has to be accounted as per functional currency. If any other currency in which a transaction has happened, that is considered as a foreign currency, and the adjustment has to happen for the remeasurement. Okay, we have understood the primary indicators. Let us take some example to understand the concept of primary indicators. Here I am saying the entity sells all over the world, but the products are for convenience sakes priced in US dollar. However, labor, material, other costs are settled in INR. What is the functional currency? So let us first try. What are all the three elements? What is the currency in which majority of my sale prices for goods and services are determined and settled? Can I apply that principle here? I am selling all over the world. So all over the world, when I'm doing, for convenience sake, I'm pricing in US dollar. So settlement is happening in US dollar. But it says only for convenience I use US dollar. So that means it creates some sort of doubt whether the first condition is fully satisfied. We come to the second one where the competitive forces or the regulation of the country influences my selling price. No, because I have only done that based on my own convenience and nobody is influencing it. So the second condition is not at all to be considered. But the third condition, where my labor, material, and other cost of providing these services or selling the goods is incurred in INR, so that is very bright line, or it gives a complete clarity on based on which, and the other factor that it is only for convenience they have priced it in US dollar and not decided and settled in US dollar. So in this case, INR becomes the functional currency based on the third condition and the facts given in this particular scenario. Let's twist this question. Suppose for the convenience, if it is not there, it primarily sells in products in US dollar, then it's a mixed position. So selling price, first condition is also satisfied, third condition is also satisfied. Then we are confused whether first has to be applied or second has to be applied, whether equal weight has to be given, which has to be given higher weightage. In that scenario only, it says that you go for supporting evidence by looking into your secondary indicators. Primary indicators is confused. We are going as a supporting evidence with the secondary indicators. We will see secondary indicators later. But for you, your understanding, in case if there is a difference in this particular facts cases, there could be an additional implication which we have to see with respect to the secondary indicators. Let's take one more example. I think that we have seen this in one of the example already, where it generates the cash flow. The subsidiary generates the entire cash flows and transfers the cash flows to the uh, parent company. Parent company is a US based company, and the cash flows, sorry, the parent company is Indian company, and the subsidiary is US based company. Even though it operates in US, what is the functional currency is the question which we are having. Since we said that primary economic indicators saying that it's operating in US, so functional currency should also be in US dollar. But interestingly, what it says is that remittance of the cash flows. So here we are simply saying it only remits the cash flows to the parent company, and to that extent, whether it is a decision of autonomy or not an autonomy, it is not clear in this fact pattern. Assuming that based on the answer, I am just thinking that in this fact pattern, US company is having its own independent cash flows, and only whatever cash flows it generates, it sends it to the B parent company, which is company B, because its loan has been taken from that. So the loan has been taken is not the primary influence on the autonomy. That's what the facts of the case, which I assume that there are some more information which is required. We assume that that type of autonomy is available for the US subsidiary. To that extent, the primary economic environment in which the US subsidiary operates is nothing but US dollar, and accordingly, that becomes the functional currency. Suppose if I am saying, no, no, there is no autonomy, then it becomes a INR for US company as well. Having seen the primary indicators, now the next question which we have to consider is, we are confused now, where we have made a twist of the case where selling prices are in US primarily, and also the expenses are incurred in US dollar, Indian currency. How I will consider US dollar or in INR? He said, and secondary indicators are supporting evidence to decide where you have to give the weightage. Let's see what is the secondary evidences. How the company generates funds for its financing activity. For example, in the case where we said selling prices are denominated and settled in US dollar, and the primary cost of doing that sales is in the labor, material cost, and other costs are incurred in INR. So we are confused. Suppose in that example, we are saying the company raises its funds for financing activities in India in INR, then the supporting evidence shows that the economic environment in which it operates is basically in INR, and to that extent, INR will be the functional currency. So when the indicators of or the primary indicators are mixed, we are looking for an evidence, and one of the evidence is what is the currency in which the funds are raised for the financing activities. We said that I am raising an Indian loan, and to that extent, it gives me a supporting evidence. Another indicator which also says that now I have also taken loan from foreign countries. In ECB, I have taken, assuming that I have taken in US dollar also. I have Indian loan. I have also have US dollar loan. Secondary indicator also gives my confused position, because primary indicator is giving me a doubt whether it's a US dollar or INR. I'm looking for how the finances are raised for the financing activities. That also gives a mixed situation. So what could be the other indicator? What is the currency in which my receipts from operating activities are retained, or cash and cash equivalent, or my working capital management is done in which currency? If I say it's INR, the supporting evidence now shows me my functional currency is only INR. We have to see all these primary indicators and secondary indicators to decide on functional currency. Having said that, uh, this secondary indicators has to be applied only if the primary indicators are not clearly determinable. When I apply the three indicators of uh, functional currency as the primary questions or primary indicators, I get the answer, then I should not look into the secondary indicators. For a simple reason, if it is already clear, why we have to confuse ourselves further? It's a simple way of understanding. Only if it is mixed, then we go for secondary indicators. So we understood this. Suppose if secondary indicators are also not giving a clarity, then it is based on the judgment of the management. What is the currency which you wanted to apply based on your judgment? What is the economic environment you operate? That's what your assessment. That is what it says. When it's mixed, then you go for judgment. Now, what is the functional currency of a foreign operation? So here I have already picked one portion for us to understand. The other portion we have not talked about. So we will see what are all the indicators that to determine the functional currency. It is an additional indicator. Primary indicator and secondary indicators are simple, but when I'm talking about what is the functional currency of my foreign operation, because functional currency of the foreign operation is different from the functional currency of or the presentation currency of the entity, then there is a translation which happens, right? So that's what we have seen earlier. Now, what is the indicators which shows that I have to determine the functional currency based on those indicators of foreign operation? The first thing is whether the foreign operation has a substantial degree of autonomy. Even though there is no specific discussion which has been made, I will suggest you to see what is the indicators of an independent foreign operation, or where there is an autonomy, it is there. There are 8 parameters which we are seeing in AS11. More or less the same parameters you can apply, and you will get whether the subsidiary is significantly uh, dependent on the parent or independent of the parent. If it is independent, I say it has an autonomy. If I say that no, autonomy is not significant, it is depending on the parent, then the transaction will be based on the parent's functional currency. If I have a significant autonomy for the subsidiary, the functional currency will be based on the primary and secondary indicators of the country in which that is operating, the foreign subsidiary is operating. Second additional portion or additional indicator which we will see is what is the proportion of the transaction with the reporting currency. For example, if I am saying the entire supplies are made by the parent company and the foreign subsidiary just sells and remits the money back. So it is fully dependent on the supplies made by the parent company. The proportion of transaction is very high. So that could also give an indication that the functional currency of the foreign operation is also equivalent to the functional currency of the parent company, not a separate functional currency. Suppose if there is no proportion of transaction, it is only made an investment, and all other operations are being done with a significant degree of autonomy, and the purchase, sales, everything is happening independently and not dependent upon the parent company. That shows that the foreign operation is an independent foreign operation, and to that extent the functional currency will be determined based on the primary and secondary indicator of that particular economic environment. Suppose uh, the operations of the foreign subsidiary directly affects the cash flow of the reporting entity. So one example which I can, maybe I will take this with whatever example which we have discussed, is that I have said that only as a pass-through entity for some taxation benefit. And accordingly, whatever cash flows which the reporting entity, sorry, which the subsidiary generate or foreign operation generate, automatically impacts my cash flows also, because it's a just a pass-through transaction. So in that case, significant autonomy is also not there. And the entire cash flows of the reporting entity is affected by the foreign operation. So in that case also, the functional currency of the reporting entity will be the currency of the foreign operations as well. Another indicator which we have to consider is that whether the foreign operation generates sufficient cash flows for its own operation are completely dependent on the parent company. Every funding has to be from the parent company. It cannot generate or raises funds in the country in which it operates. So even if it has to be raised, it's only because of the parent company it can be raised. So if the cash flows which it is generating for the operating activities in that particular country is not enough, and it has to be financed only by the parent company. A normal example which I can talk about is that in some cases where a foreign operation has been set up as a branch activity, and whatever funds required for expenses or maybe as a licensing office or as a project office is being financed by the parent company, to that extent the foreign operation is considered to be completely insufficient with the cash flows it generates on its own. So in that case, the functional currency of the foreign operation will also be the functional currency of the reporting entity. Okay. So now we understood how the foreign currency of functional currency of a foreign operation has to be determined. We have to see the primary indicators, secondary indicators, and also the additional indicators. Now we move on with some examples to understand this concept. What it happens here, subsidiary of an Indian entity sells goods imported from the reporting entity and remits the proceeds to it like a branch operation, or maybe only as a trading subsidiary established in a foreign country. And for any expenses, support should come from the parent company. In that case, what is the functional currency of A? Assuming that it operates in US, whether it's US dollar or INR, there is no substantial degree of autonomy. Majority of the transactions, that's the secondary indicator which we have seen, additional indicator which we have seen, majority of the transactions are reporting entity, and the activities of the foreign operation directly affords the cash flows because it sells and sends a amount here. If it is not selling, I am not able to collect it. Okay, my cash flows are directly impacted. So to that extent, INR will be considered as a functional currency for the foreign operation and not US dollar. Okay, let's take one more example. Again, the company is in US, that's a subsidiary is in US, parent is in India. What is the functional currency of the US subsidiary, which is the company A? Here, what the fact pattern says, the subsidiary accumulates cash and other monetary items, incurs expenses, generate incomes, arranges its own borrowings, all are substantially in US dollar. So that means what it happens, it is almost independent, because first condition which we have seen in a foreign operation as an additional indicator is that it is the substantial degree of autonomy. Here it's almost completely independent. Second, we have seen what is the proportion of transaction with the parent company. It is actually doing its own transaction. That is also over. Whether it directly affects the cash flow? No, it is actually generates and retains the entire assets and liabilities, everything in US dollar, and only when it declares dividend, it will come to the cash flows. But it is not directly impacting. Suppose if it's not distributing any dividend, no cash flows will come. So that additional indicator is also not impacted. Whether it has sufficient cash flow generated on its own, yes, it was even able to arrange borrowings on its own in US dollar, and accordingly the functional currency will be US dollar. So all the four parameters are given. And let us ask one more question. Whether additional indicators should alone be considered for determining the functional currency of the foreign operation. Please be clear. Functional currency is determined by the foreign entity first, then only it goes for the other activities. For the parent company to decide what is the functional currency of the foreign operation, I'm looking for the the primary indicators first, secondary indicators second, and then I will also look into the other factors because it's a foreign operation for me and how the foreign operation has to be determined as per Ind AS 21. So even for the subsidiary in US, if it prepares its own standalone financial statement, determining the functional currency should be the first point based on primary indicators. If it is mixed, go for the secondary indicators. If it is mixed, use judgment. That is for standalone at US level. As far as the functional currency for foreign operations, when I am considering this for consolidation here, whether it should be US dollar or INR, I will consider that as a US dollar because of the additional facts which has been, or additional indicators which has been fulfilled by the foreign operations. Now, we will have some more examples. Here it is again a US subsidiary, and it has significant revenues and comparative forces in US dollar. Primary indicators which say significant revenue and comparative forces also denominates or forces you to determine the selling prices in US dollar. 70% of the cost is in INR, 30% is in US dollar. So primary forces, one indicator helps me to say that it's a US dollar. Cost is also 70%, but the cost is incurred 70% in INR. Then I am confused. Cost is showing that in the primary indicator shows that it's a INR is the functional currency. 78% of the finances have been raised in US dollar. So raising the US dollar is not giving me anything relating to primary indicator. But the secondary indicator says how the substantial funds are raised for its operating activities. It's in US dollar. So I am moving towards US dollar now. Primary indicator shows one point towards US dollar, secondary and one towards INR. But the secondary indicators gives me one more point towards US dollar, and it also says it keeps the cash flows partially in US dollar and partially in INR, because we are saying how it maintains that. What is the functional currency of A? It's a question of mixed indicator. However, based on the supporting evidence which I have applied, that is 2 points in favor of US dollar and 1 point in favor of INR. So I have concluded that majority of the indicators shows the functional currency is US dollar. But what we are trying to do here is we are not stopping at just the primary indicator. We are looking for supporting evidence in the secondary indicators. And we are also seeing what are all the other judgment which I have to apply. And in this case, the company will conclude that US dollar will be the functional currency. Suppose if the company is operating in a hyperinflationary economy. What do you mean by hyperinflationary economy? Ind AS 29 actually deals with that situation where the local currency is fluctuating very heavily with the foreign currency. Regular high fluctuations. It's a hyperinflationary economy. And to that extent, the transactions cannot be simply considered based on the principles of Ind AS 21. What it says is that go and restate the financials according to Ind AS 29. Ind AS 29 says that you have to actually do based on the principles of what is the realizable amount at the foreign currency existing and not based on historical cost, etc. Okay, that's what it says. So Ind AS 29 should be applied in that particular scenario, and the principles will also be in accordance with hyperinflationary economy. You cannot simply say my functional currency is this, my foreign currency is this. And and accordingly I will do the measurement in a different style. Not possible in hyperinflationary economy. Ind AS 29 will prevail over Ind AS 21. Let's move. So, just to recap, we have considered functional currency, transaction currency, and presentation currency. We have seen the primary and secondary indicators to determine the functional currency. We have also seen additional factors to determine the functional currency in respect of net investment in a foreign operation. And we have also seen the accounting treatment relating to uh, monetary assets and non-monetary assets. And that brings us to the conclusion of this presentation. Hope you have uh, enjoyed this, and all your questions have been properly explained with a lot of practical case studies. And in case if you are still having questions or clarification, you are always at liberty to get connected with me and post your comments in the channel itself, so that I can address that comments or queries in the channel for the benefit of all the subscribers to the channel. And as I have told by many of the YouTube channel being maintained by the YouTubers, they have said that if anybody is subscribing to your YouTube channel, any update you are giving will automatically go to them. That means the notification automatically comes to them. So you are not at the mercy of any of your friends for a forward of my videos if you are a subscriber to the channel. And to that extent, I am also thinking that the knowledge base will be widened further. And I'm also very happy that I'm interacting with so many people. So uh, with that in mind, I will request you to share this video and encourage the people to whom you are sharing the video to be part of our YouTube channel. I feel that it's our YouTube channel, not my YouTube channel, because it is for the purpose of sharing the knowledge, and every subscriber will get, I hopefully, that good benefit out of viewing this video. With that, I will take leave from you, and we will meet with another video uh, with respect to another Ind AS standard as part of our Ind AS knowledge video series. Thank you. Stay at home and stay safe during the lockdown period. See you. Goodbye.